if you own stocks, if you have a 401k, if you save money in dollars. And then what I am about to show you has already wiped out wealth over and over again throughout history. Not once, not twice, repeatedly. Different countries, different centuries, different political systems, same ending. And right now, for the first time ever, the United States is spending more on debt interest than on its entire military. Let that sink in. By the end of this video, you all understand why currencies fail, how often it happened, and most importantly, how to structure your portfolio so that even if you are wrong on timing, you're still protected. This isn't doom. This is pattern recognition. Well, let's start with Roman Empire, the perfect case study. In 64 AD, Emperor Nero had a problem. Massive fires, expensive wars, empty treasury. No printing press back then, so he did the next best thing. He debased the currency. Roman silver coins were originally about 95% silver. Nero quietly reduced it to 90%. Small change, no one will notice, but future emperors copied him. Over the next 200 years, silver content fell and fell and fell. By around 260 AD, some coins contained less than 5% silver, basically copper with a thin silver coating. What followed? Hyperinflation, loss of trust, soldiers demanding payment in goods, economic breakdown. The empire fractured. Officially, the coins were worth the same. Reality, they bought less. Sound familiar? And this pattern didn't stop with Rome. Germany, Weimar Republic, 1923. Workers paid twice daily, wheelbarrows of cash for bread. Russia, Soviet Union, 1991. Savings wiped out almost overnight. Britain, the pound slowly lost global dominance after World War II. Different cultures, same outcome. Currencies don't usually die suddenly. They decay quietly. Most people imagine collapse as chaos. That's not how it usually happens. You still go to work. You still buy groceries. Money still works. It just buys less every year. Since 1913, when the Federal Reserve was created, the US dollar has lost about 96% of its purchasing power. That's not opinion. That's government data. What cost $1 now costs roughly $30. That's currency degradation, not inflation. Degradation. Meanwhile, wages lag savings accounts pay 4%. Real costs rise 7-10%, so you fall behind quietly. No headlines, no emergency, just slow erosion. Every government faces the same choice. Cut spending, raise taxes, lose elections, spend freely, borrow more, print money, stay popular. Every politician chooses option 2. Debt grows, interest compounds. Eventually, new debt pays old interest. It becomes a loop, and there's no politically acceptable exit. You can't raise taxes enough. You can't cut spending enough. You can't default, so they inflate, quietly. That's the invisible tax. Here's where it gets interesting. Central banks are buying gold at the fastest pace in 50 years. Not retail investors. Central banks, they're diversifying away from paper. Why? Because they understand the cycle. And wealthy investors, they don't hold piles of cash. They own businesses with pricing power, real estate commodities, hard assets. Even Warren Buffett doesn't want to sit on idle cash. He uses cash equivalents that generate massive interest. Big institutions position before headlines appear, always. This is where most people get it wrong. They panic. They move to cash. But cash is just an IOU from someone who can create unlimited IOUs. Instead, historically, the people who preserved wealth owned businesses with pricing power. Companies like Amazon can raise prices. Customers still pay. Real estate. It's real, physical, limited supply. Rents rise with inflation. Commodities, especially gold and silver, not speculation. Insurance. They have zero counterparty risk. Gold doesn't rely on promises. Diversification. No single bets, not all stocks, not all gold, not all property. Survival matters more than perfect returns. Here are the rules. Never go all in on one idea. Diversification protects you when you own your own wrong. Own assets. Not paper cash melts over time. Hold insurance gold, silver, maybe Bitcoin. Small allocations. Stay humble. No one knows timing. Structure beats prediction. Currency collapse isn't sudden. It's gradual. Rome took centuries. Britain took decades. People don't notice the beginning. They only notice the end. Meanwhile, wealth quietly transfers from savers to owners, from paper holders to asset holders. Every currency has a lifespan. That's history, not fear. The smart move isn't panic, it's positioning. Because doing nothing, that's still a decision. And usually it's the most expensive one.